Analysis: some investors wager top growth stocks will thrive in U.S. recession. New York concerns about a possible U.S. recession are prompting a few fund managers to rotate returned into the big tech and growth winners of the remaining decade within the hope that they could better weather an monetary typhoon. Many stalwarts like Microsoft Corp. Nasdaq, MSFT, Apple and Google parent Alphabet Nasdaq, Google Inc. have suffered declines on par with or exceeding the ones in broader stock indexes this year, as jumbo rate hikes introduced by way of an inflation-fighting Federal Reserve hit the tech and increase names that led markets in preceding years. Since growth groups have a tendency to be much less suffering from the broader economy's performance, but some buyers agree with the category's most profitable names may additionally outperform the relaxation of the market if the Fed's hawkish coverage stance drags the U.S. into recession. You are beginning to see a few cracks in financial increase, with a purpose to help pick out agencies which can be thoroughly positioned inside the era space, stated Sarah Malik, Chief Investment Officer at Nuveen, who has been growing her positions in agencies inclusive of Amazon.com Inc., Nasdaq, AMZN, and Salesforce.com Inc., NYSE, CRM. The conceptual corporations that don't have profitability will stay challenged due to the fact you need actual fundamentals to return it up, she said. The trade remains a nascent one. Global fund managers have elevated their allocations to tech via about 7 foundation points as measured through the state-of-the-art survey from BofA Global Research, although they remain bearish on the sector as an entire. Retail buyers, in the meantime, were shopping for evergreen massive tech corporations such as Apple Inc., Nasdaq, AAPL on latest marketplace dips, consistent with Vanda, Nasdaq, VNDA research. Overall, the Russell 1000 Growth Index is down 28.4% year-to-date, well in the back of the 13.9% decline for the Russell 1000 Value Index, which incorporates shares in extra-economically sensitive sectors like energy. The benchmark S&P 500 index is down 20.7%, marking its worst first half of the year for the reason that 1970. Some names in tech have suffered even steeper losses. Cathie Wood's ARK Innovation ETF, which holds an array of more recent agencies along with Zoom Video Communications, Nasdaq, ZM, and Teladoc, NYSE, TDOC, is down 57.7% year-to-date. Meanwhile, recession issues have grown in recent weeks. A worldwide ballot of traders by using Deutsche Bank ETR, DBKGN, in June determined that 90% now expect a U.S. recession by the quid of 2023, up from 78% the month before. Attractive valuations, for Jack Janasevich, lead portfolio strategist at Natixis Investment Managers Solutions. Those issues are an awesome motive to increase positions in companies including Google parent Alphabet. Janasevich is likewise making a bet that the pounding their stocks have taken has decreased valuations to attractive stages. The ahead fee-to-income ratio for the S&P 500 generation area, for instance, is down to 19.1, its lowest level on the grounds that early 2020, in step with Yardeni research. We are seeing a number of the most appealing valuations for this space that we've visible in a long time, Janasevich mentioned. Of root, signs of persevered excessive inflation ought to in addition ramp up expectancies for Fed hawkishness, potentially using up bond yields and dealing some other blow to tech and boom stocks. Higher yields dull the appeal of businesses in technology and different high-growth sectors, whose coins flows are frequently heavily weighted within the future and are faded when discounted at higher costs. Earnings season, which kicks off in July, may additionally present every other danger. One important aspect for tech organizations is possibly to be the energy of the dollar, which cuts into earnings from remote places' earnings.